Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out if a company is playing by the rules or if it's about to get a big red flag from Uncle Sam. Today we're diving into Clearside Biomedical, and let me tell you, it's a bit of a dramatic performance with their stock getting a heads up that it might be kicked off the big leagues. Plus there's a big vote happening, so grab your popcorn. Alright, so Clearside Biomedical has sent out an 8K filing telling us about some important stuff that's been going on. Think of an 8K as a company's way of shouting out to the world about really significant events that happen between their regular reports. The big news dropped on August 28th of this year, and it's all about their common stock. This is the company we're talking about, Clearside Biomedical. Now, the folks who keep track of which companies get to trade on the big stock exchanges, NASDAQ in this case, sent Clearside a notification. It turns out Clearside's stock value has fallen below a certain level. NASDAQ requires to stay on their main market. NASDAQ has this rule that companies need to have a market value of at least $50 million. It's like a minimum score you need to stay in the game. This is called the market value of listed securities, or MVLS for short. The good news is this notice doesn't mean their stock is delisted right now. They have a grace period, almost 6 months until February 24th of next year, to get their act together and bring that market value back up. To get back on track, they need their stock market value to stay at $50 million or more for 10 days in a row before that February deadline. If they don't manage it, NASDAQ will then say it's time to pack up. Clearside is thinking about a couple of things. They might try to fix the current situation and stay on the NASDAQ global market, or they might try to move their listing to another NASDAQ market, the capital market, which has slightly different rules. This isn't the first time Clearside has had a warning from NASDAQ. Back in February, they got another notice because the price of their stock, the bid price, had been too low for 30 days straight. It was less than $1, so even before this new NVLS issue, they were already facing problems. Because they didn't fix the low stock price issue within the deadline, NASDAQ said they were subject to delisting, but Clearside asked for a hearing to argue their case, and that automatically pauses any delisting. So their stock can keep trading on NASDAQ for now while they sort things out. And what are they doing to fix this? Well, they're asking their shareholders to approve something called a reverse stock split. Imagine you have $10 bills, and instead of 10 ones, you swap them for one $10 bill. That's kind of what a reverse stock split does to shares. They plan to consolidate their shares, maybe merging 5, 10, or even 15 old shares into one new share. This usually boosts the price per share, which is what they need to meet NASDAQ's minimum bid price requirement. And that brings us to the second big part of this filing. On August 29th, Clearside held a special meeting for all their shareholders. The main thing they voted on was approving the plan to do this reverse stock split. They gave themselves some flexibility, allowing the split to be anywhere from a 1-for-5 to a 1-for-15 ratio, and the board of directors will decide the exact number. A good chunk of the company's shares were represented at this meeting, over 62% of the total shares outstanding. That's a healthy turnout, meaning the decision should have good backing. And the vote results? Over 46 million shares voted for the reverse stock split. Only about 2.2 million shares voted against it, and a smaller number, less than 500,000, abstained. So the shareholders overwhelmingly said yes to the reverse stock split. This gives the company the green light to try and boost their share price to meet NASDAQ's rules. Now, let's think about this from a strategic perspective. Clearside is in a tough spot. They're facing delisting from NASDAQ twice over. First for low stock price and now for low market value. This reverse stock split is a common tool for companies in this situation. However, it doesn't magically make the company more valuable. It's more like rearranging deck chairs on the Titanic. Without a solid business plan and clear path to profitability, the stock price often continues to slide even after a reverse split. The fact that their market value is below $50 million shows that investors as a whole don't believe the company is worth that much right now. This could be due to many reasons like slow growth, tough competition, or concerns about their products or management. While the shareholders have approved the split, the real challenge for Clearside is to demonstrate that their core business is strong and can grow. Looking at this filing, the main story is about survival and meeting the basic listing requirements of the stock market. It's a clear signal that Clearside Biomedical is struggling to maintain its presence on a major exchange. The success of the reverse stock split in the long run hinges entirely on whether the company can deliver actual business results that make investors confident again. What are your thoughts on this? Do you think Clearside can turn things around with this reverse stock split, or is this just a temporary bandage on a bigger problem? Let me know in the comments below. If you found this deep dive helpful, please smash that like button. It really helps us out. And don't forget to subscribe for more corporate breakdowns. We also have a Discord community where we discuss these things further, and you can find that link in the description. Thanks for watching, and we'll see you in the next one.